Imagine you walk into a dealership and buy a brand new car for $40,000. You drive it off the lot, circle the block, and pull back in 5 minutes later to sell it. You would expect to lose money, right? That is the famous depreciation hit. But now, imagine you buy a house for $350,000. You do everything right. You paint the walls, you mow the lawn, and you stay for 4 years. In those 4 years, the market actually goes up. You sell that house for nearly $400,000. You are feeling like a real estate mogul, a financial genius in the making. Then, you sit down at the closing table, and the attorney slides a piece of paper across the desk. You look at the final number, and your heart sinks. Despite the higher sale price, you have actually lost over $50,000 in net wealth, compared to if you had just stayed in your apartment and done nothing. This is the starter home myth. It is a mathematical trap designed by the real estate industry that treats your net worth like an all-you-can-eat buffet for agents, lenders, and tax collectors. Today, we are going to look at why buying small can absolutely wreck your finances. For decades, we have been fed the same financial script. Graduate, get the job, get the spouse, and buy the starter home. We are told it is a vital stepping stone, a way to stop throwing money away on rent and start building equity. It sounds logical, almost noble. But logic without math is just a fairy tale. If you are here, it is probably because you suspect the standard advice is a bit dusty. You want the numbers, not the slogans. That is exactly what we do here. We look at the spreadsheets the banks hope you never open. If you find that this kind of deep dive, no-nonsense analysis is the best return on your time, go ahead and hit that subscribe button. It is the only investment I know of with a guaranteed positive ROI and zero closing costs. I have spent the last few weeks running the numbers on the 4-year ownership cycle, and the results are frankly terrifying. We are going to dismantle this myth piece by piece, starting with the most dangerous phrase in the English language. Renting is throwing money away. Whenever I mention renting, someone inevitably chimes in with the classic line, "Why would you pay your landlord's mortgage when you could pay your own?" It is a powerful emotional anchor. It makes renting feel like a failure of character. But in the world of financial literacy, we have to separate utility from investment. When you buy groceries, you are not throwing money away. You are buying the utility of nutrition. When you rent, you are buying the utility of shelter and, more importantly, the utility of mobility and capped risk. The mistake people make is assuming that every dollar of a mortgage payment is a dollar saved. It is not. Homeownership is riddled with its own version of thrown away money. We call these unrecoverable costs. When you rent, your unrecoverable cost is simple. It is the rent. When you own, your unrecoverable costs are a multi-headed hydra. You have mortgage interest, which is basically rent you pay to the bank. You have property taxes, which is rent you pay to the government. You have homeowners insurance and maintenance, which is rent you pay to the universe just to keep your house from falling apart. On a short-term horizon, like the 4 years typical of a starter home, the sum of these unrecoverable costs often dwarfs the cost of a rental. You are still throwing money away. You have just changed the recipient from a landlord to a bank. Let us get specific. If you rent a 3-bedroom house for $2,500 a month, your annual unrecoverable cost is $30,000. Simple. Now, let us look at the homeowner of an identical house. Their mortgage payment might also be $2,500. On paper, it looks like a wash. But look closer. In those early years, about $1,800 of that monthly payment is pure interest. That is $21,000 a year gone. Then add property taxes at $4,000 and insurance at $2,000. Now we are at $27,000. We haven't even touched maintenance yet. If you spend just 1% of the home's value on repairs, that is another $3,500. Suddenly, the homeowner is out $30,500 in unrecoverable costs. They have spent more money to live in the same house than the renter, and they are the ones responsible when the water heater explodes at 3 in the morning. The renter has a fixed cost. The homeowner has a minimum cost. When you factor in the massive friction of actually buying and selling that property over a short window, the renter starts to look like the one who is actually being frugal. The idea that renting is inherently wasteful is a psychological trick that ignores the reality of how money actually leaves your pocket. There is a hidden cost to home ownership that almost nobody discusses at dinner parties: the cost of being stuck. I call it the liquidity penalty. When you rent, your capital is liquid. That down payment you didn't spend is sitting in a brokerage account or a high-yield savings account, or perhaps an index fund. It is working for you every single day. If a better job opportunity comes up 3 states over, you can pack your bags and go. Your wealth moves with you. But when you buy a starter home, you are effectively burying $50,000 in the backyard. You cannot eat it, you cannot spend it, and you certainly cannot move it quickly. If the local economy takes a dip, that money is trapped in a declining asset. This lack of mobility is a silent wealth killer for young professionals. The fastest way to increase your lifetime earnings is through geographic and professional mobility. By anchoring yourself to a starter home for the sake of equity, you might be trading a $50,000 salary bump for a $3,000 principal paydown. That is a trade no sane mathematician would ever make. Real wealth is not just about what you own, it is about how easily you can pivot when the world changes. So, what is the protocol here? It is not about never buying a house. It is about understanding that renting is a strategic tool. Think of rent as an insurance premium against the massive risks of the real estate market and the friction of transactions. Before you buy that small house, ask yourself if you are willing to pay a massive premium for the feeling of ownership. If you cannot commit to a location for at least 7 to 10 years, renting is almost always the mathematically superior move. It allows you to keep your capital in high-return environments like the stock market, while maintaining the flexibility to chase career growth. The goal of financial literacy is to maximize your net worth, not to satisfy a cultural milestone that was invented in the 1950s. We need to stop viewing renting as a failure and start viewing it as a sophisticated financial hedge. But wait, it actually gets worse. Because even if you are okay with the monthly costs, there is a hidden monster waiting for you at the beginning and the end of the ownership journey. It is called transactional friction, and it is the reason you can lose money even when your home value goes up. If you buy $1,000 worth of an index fund today and sell it tomorrow, you will have roughly $1,000. The cost of the transaction is effectively zero. But real estate is not a liquid market. It is a swamp of fees. If you buy a house for $300,000 and sell it the next day for the same price, you are not break even. You are probably $30,000 in the hole. This is what I call transactional friction. It is the collective weight of everyone who takes a slice of the pie just for the privilege of you moving your stuff from point A to point B. When you buy a starter home with the intent to leave in 4 years, you are basically volunteering to pay these massive fees twice in a very short window. You pay to get in, and you pay significantly more to get out. Most people ignore these costs because they are rolled into the loan or taken out of the sale proceeds, so they never actually see the cash leave their hands. But just because you don't physically count the hundreds doesn't mean they aren't gone. Over a 4-year period, these friction costs are like a massive parasite on your net worth, sucking away every bit of appreciation you might have hoped for. Let's look at the entry fee first. The sticker price of a home is a lie. When you see a house for $350,000, the actual cost to acquire that keys is closer to $365,000. These are your closing costs. We are talking about loan origination fees, appraisal fees, title insurance, home inspections, and prepaid taxes. These costs typically range from 2 to 5% of the loan amount. For a standard starter home, that is $12,000 vanished on day one. Think about that. You haven't even spent one night in the house yet, and you are already down $12,000 in net worth. To break even on just your entry costs, your house has to appreciate by roughly 3.5%. In a normal market, that takes at least a year, sometimes two. If you are only staying for 4 years, you have already spent 25% of your total ownership time just trying to get back to zero. And remember, that $12,000 isn't equity. It doesn't make the house worth more. It is just the fee you pay to the bank and the government to be allowed to play the game. It is a sunk cost that starts your ownership journey in a deep financial hole. If the entry fee is bad, the exit fee is devastating. This is the part of the starter home myth that people conveniently forget when they are looking at Zillow estimates. In the United States, the seller typically pays the commission for both the buyer's agent and their own agent. This historically hovers around 5 to 6% of the total sale price. Notice I said sale price, not profit. If your $350,000 starter home appreciates to $400,000, you might think you made $50,000. But the agents are going to take 6% of that $400,000. That is $24,000 right off the top. Suddenly, half of your profit is gone. But wait, there is more. You have to pay for staging, minor repairs to make it market ready, and often seller concessions where the buyer asks you to cover their closing costs. Toss in transfer taxes and title fees, and you are looking at losing 8 to 10% of the home's value just to sell it. On a $400,000 sale, that is $40,000 in friction. If you only made $50,000 in appreciation, you are left with $10,000 to cover 4 years of maintenance, insurance, and interest. The math is brutal. You are doing all the work, taking all the risk, and the real estate agents are the ones walking away with the lion's share of the wealth. This is why the industry loves the starter home concept. It guarantees a new commission every few years. The final piece of the friction puzzle is the amortization schedule. Most people think that if they pay $2,000 a month for their mortgage, they are slowly buying back their house from the bank. But the bank isn't stupid. They want their profit up front. In the first few years of a 30-year mortgage, the vast majority of your payment goes toward interest, not principal. At a 6% interest rate, about 80% of your payment in year one is pure interest. You are barely chipping away at the debt. After 4 years of making heavy monthly payments, you might find that you have only actually paid down about 5% of the original loan. When you go to sell, you still owe the bank almost everything you borrowed. Between the front-loaded interest, the entry closing costs, and the massive exit fees, the 4-year homeowner is almost always mathematically behind a renter who simply invested the difference. This isn't just bad luck, it is how the system is designed. To fight back, you need a system of your own. That is why I created the ultimate personal finance dashboard. It is the exact spreadsheet I use to track my true net worth, factoring in these hidden costs so I never get fooled by a Zillow estimate. You can find the link to the dashboard and my other trackers in the description below. To really see how this plays out, let's look at a tale of two investors, buyer Ben and renter Rachel. They both have $50,000 in the bank, and they both need a place to live for the next 4 years. Ben decides to buy a $350,000 starter home. He puts down 10%, pays his closing costs, and moves in. He is proud. He feels like he has finally made it. Rachel, on the other hand, decides to rent the house next door for $2,200 a month. Her friends tell her she is crazy, that she is throwing her money away. Rachel just smiles and takes her $50,000 and puts it into a boring S&P 500 index fund. She also notices that her total monthly housing cost is about $600 cheaper than Ben's when you factor in his taxes, insurance, and the inevitable broken dishwasher. Every month, Rachel takes that $600 and adds it to her investment account. Ben is building equity, or so he thinks. Rachel is building a portfolio. They both live in identical houses, in the same neighborhood, with the same commute. For 4 years, their lives are virtually the same. But under the surface, a massive financial gap is opening up. 4 years pass. The market has been good, and the houses have appreciated by 3% a year. Ben's house is now worth $394,000. He decides it is time to move up to his forever home. He sells the house and, after paying the agents and the closing costs, he walks away with a check for about $65,000. He is thrilled. He turned his original $35,000 down payment into $65,000. He thinks he made $30,000 in profit. But let's look at Ben's total outlays. Over those 4 years, between the mortgage, the taxes, the insurance, and the maintenance, Ben spent over $139,000. If we subtract the $65,000 he got back, Ben's net cost of housing for those 4 years was $74,000. That is $18,500 a year. Not bad, right? But wait until you see Rachel's side of the ledger. Ben's biggest mistake wasn't the house itself. It was the opportunity cost of the money he tied up. He didn't just spend $74,000. He also gave up the growth that money could have earned elsewhere. In the world of finance, what you didn't earn is just as important as what you spent. Now let's look at renter Rachel. Over those same 4 years, Rachel paid $112,000 in rent and insurance. On the surface, it looks like she spent more than Ben. But remember Rachel's investments. That $50,000 she started with? In a standard index fund at 7% growth, it is now worth $65,000. And those $600 monthly contributions she made with her savings, those have grown to over $30,000. Rachel's total investment portfolio is now worth $95,000. If we look at her net position, she spent $112,000 on rent, but gained $45,000 in investment growth. Her net cost of housing was only $67,000. Compared to Ben's net cost of $74,000, Rachel is $7,000 ahead in cash. But it gets better. Rachel's $95,000 is liquid. She can use it for a massive down payment on a forever home, or she can keep it growing. Ben's wealth is gone, eaten by agents and banks. Rachel didn't have to worry about a leaking roof or a cooling market. She had a fixed cost of living and a growing pile of assets. By choosing to rent and invest, she effectively got paid to not own a home. This is the power of avoiding friction and embracing the stock market's efficiency over the real estate market's bloat. The verdict is clear. Over a 4-year window, the renter wins. The starter home isn't an investment. It is a high-interest, illiquid lifestyle choice. The only way Ben wins is if the housing market has an absolute explosion of growth, far beyond the historical average. But banking on an explosion is called gambling, not investing. If you want to build real wealth, you have to play the percentages. The percentage play is to rent until you are ready to stay put. If you can't see yourself in a house for a decade, you are almost certainly better off putting your money in a low-cost index fund and letting the magic of compounding do the heavy lifting without the drag of agent commissions. This is the kind of analysis we dive into every week here at Tom Talks Money. If you want to join a community that values data over dogma, consider clicking that join button to become one of the optimizers. You will get priority replies to your questions and help shape the future of this channel. We are building a fortress for our wealth, and the first step is tearing down the myths that hold us back. There is one final risk we have to discuss: the risk of going underwater. Everything we just talked about assumed the market went up. But what if it doesn't? If you buy a house with a small down payment and the market dips just 5%, your equity is gone. If you have to move for a job or a family emergency during that dip, you are in a catastrophic position. You can't sell the house because the sale price won't cover the mortgage and the agent fees. You would have to bring a check for $20,000 or $30,000 to the closing table just to be allowed to leave. This is the trap that ruins lives. It forces people to stay in jobs they hate and cities they want to leave, all because they are handcuffed to a piece of siding and some drywall. The starter home myth doesn't just wreck your finances, it can wreck your freedom. Don't let a marketing slogan dictate your life's trajectory. Run the math, protect your liquidity, and only buy when the horizon is long enough to weather the storm. I want to hear from you in the comments. Have you ever done the math on a past home sale? Did you actually come out ahead, or did the friction eat your lunch? Let's get a peer review going in the comments. I'll see you in the next one.